Good morning, everyone, and thank you for joining us today. My name is Reza. I'm the National Sales Manager here at PPS Investments. Today we have our investment team joining us, and they'll be answering a few of the burning questions you faced with out there. They'll also discuss the PPS portfolios to show just how they are positioned to be resilient in this market. So please add your questions to the comment box below, and I'll be sure to address them to the investment team a little later. So as you know, this lockdown environment has forced many of us to work very differently, forcing us to make use of technology that we are not 100% comfortable with. And as you'll hear a bit later, technology has become a huge drive in the market as well. Now, over the last 12 months, we've launched our new secure site, which will actually assist you to work 100% paperless, allowing you to assist your clients with all of their needs actually digitally. So please have a look. If you haven't logged on yet, please do so, or speak to your investment specialist to assist you with that. I'd also like to thank all of you for your brilliant contributions in this very, very difficult year we've had so far, especially for all the overwhelming support with our inter-fund conversion deal and program that we've been running now with the Section A campaign. And as you know, these clients could take advantage of a zero platform fee till retirement. This deal ends on the 30th of September, so please keep pushing. We have less than 2 months left. So please lean on your investment specialist if you need any assistance to help getting those clients actually moved over and converted over to the platform. Without any further ado from my side, I'll now hand over to Luigi Marinus to kick off our session today. Luigi.
Thanks, Razik. Good morning, everyone. Thanks for the opportunity to chat with you this morning. As Razik said, I'm Luigi Marinus, a portfolio manager at PPS Investments. With me are my colleagues, David Crosoer, our CIO, and Reza Hendrickse, another portfolio manager in our team. We're going to be giving you a broad macro overview this morning. I'll be posing a few questions to the team, and they'll be sharing some insights with you today. Broadly speaking, from a macro perspective, we're all aware that the current global lockdowns have resulted in the worst economic contraction of our lifetimes. The IMF, in fact, estimates that world GDP will shrink by 5% this year, and in South Africa, that number will be closer to 7.5%. Job losses globally will be significant, and unemployment in South Africa is also climbing steadily. Policymakers globally have responded with unprecedented stimulus, and this has led to markets rebounding sharply in what appears to be a disconnect to the economic reality we are all seeing. While this is something we will touch on, we won't be focusing explicitly on all the daily news headlines. As the cartoon on the screen suggests, who would have believed that the coronavirus would have had such a profound impact on the world? So with that in mind, if we move on to the next slide, let's have a look at how the various asset classes have performed so far this year. If everybody can see the chart, yes, I can see it now. This chart, it shows the performance of local property, inflation-linked bonds, nominal bonds, and equities, as well as global equities in both rands and US dollars since the start of the year to the end of July. The first thing one notices is clearly the volatility in the return profile, with the asset classes being down between 15 and 50% by the end of the first quarter. However, to date, inflation-linked bonds, nominal bonds, local equities and global equities in US dollar terms have effectively returned to the same level each started the year at. Domestic property is clearly the asset class that has lagged, still down about 40%, and global equities in rand terms have outperformed, but mainly as a result of the rand depreciation over that period. In terms of our fund performances, the short-term volatility is evident, but the long-term peer relative outperformance persists, with most funds delivering first and second quartile performance over 3, 5, and 7 years. Funds that delivered fourth quartile short-term underperformance was largely as a result of our bond preference, which in hindsight was a bit too early, but remains an overweight in our asset allocation. We'll delve a bit deeper into this in subsequent slides. Positive short-term performance has mainly been as a result of the domestic equity holdings, which we'll also take a look at in more detail. Over 5 and 7 years, the only fund that has not delivered first or second quartile performance has been the Balance Fund, which has actually outperformed the peer group average, but is narrowly lower than the median fund, less than 10 basis points over each period, in fact. So how do we build resilience? Let's look at our current holdings in what are considered the major asset classes. We are overweight global equities, underweight local equities, and have a maximum overweight in local bonds. I think at this time I'll turn to Reza. Reza, can you provide more insight into the overweight global and underweight local equities call? What do you see as the opportunities within equities, and how are our portfolios positioned relative to these opportunities?
Thanks, Luigi, and hi to everyone on the call here today. It's great to have such a good turnout. So as Luigi mentioned, global equity is a key overweight across the portfolios and has in fact been for quite some time now. And we think it remains a compelling asset class, particularly compared to the other alternatives that are available to us. So I'm going to start there, and then I'll carry that conversation through into local equity as well. The next slide provides a nice intro, and it's also a sign of the times that we currently find ourselves in. On the left, we have the market cap of Zoom, which is a tech company essentially, which enables these sorts of online interactions. And on the right, we can see all of the major airline companies. And what this picture really shows us is that Zoom is now essentially the size of all of these airline companies combined. And this is quite remarkable for a company that didn't exist not too long ago. And this, of course, also speaks to the fact that these days, very few people are flying, while we're all online and working remotely. But this tech theme, though, is far more pervasive. And the next slide will show us that. Here we see the various equity sectors, global equity sectors on the right, in those various clusters. And each bubble represents a company. And the size of that bubble indicates the extent to which that company's market cap has actually grown so far this year up to the end of June. And you can see that the larger bubbles are mostly tech companies, the likes of Microsoft, Apple, Amazon, Tesla, Tencent, and Facebook are among those that you'll see. And the fact is that these large cap tech companies have almost single-handedly driven the global equity market higher, despite it being a relatively narrow segment of the market. And so on the left, what we see are the top holdings in PPS Global Equity Fund, which is managed by Capital Group. And you'll notice a number of tech names in there as well. So this fund has performed well, and tech has been one of the key drivers. But PPS Global Equity is by no means just a tech story. The portfolio is actually invested across a number of themes, and it's got 7 underlying portfolio managers, and each one manages a slice of the portfolio according to their own individual style. And so the combination really gives rise to a well-diversified overall portfolio. But with tech being very much in vogue these days, the next slide begs the question of how much longer can this actually continue? And here we see that over the years, each decade seems to be defined by a very prominent theme. And all of these themes were preceded by a period of easy monetary policy. There was a constructive narrative at the time, and what we ultimately saw was a sustained period of very strong performance, much like we see in tech today. So in the beginning, we had the nifty 50s, which were dominated by companies like Disney, and these were effectively large caps with strong franchises and good dividend growth. But then we had the bull market in gold, followed by Japanese stocks on the back of very strong economic growth in that region. And then we had the internet mania, and then the China-driven commodity bull run. And now it's all about large cap tech, and Tencent is actually included in that as well. All of these themes, as you can imagine, eventually do come to an end though. However, there's a strong case to be made that the current phase wind could very well continue for a number of years. One of the big drivers behind the strong move in large cap tech is that these companies tend to behave like a very long-term bond, where the price today is affected by robust cash flows quite far out. So just like bonds have rallied as yields have come down, in this low interest rate world we're in, we think this will continue to support the share prices of these types of companies for quite some time to come. But if not, then even in that case, the portfolios are not overly exposed. And that's because exposure is measured, with portfolios being diversified across multiple themes, managers, and asset classes. So now I've shared some of the performance, some insights into the performance of global equities, that is, and I've spoken to the dominant theme at play. But I think the elephant in the room really is the slide over here. with stocks having rebounded so strongly, the latest move seems almost counterintuitive given the bleak macro picture, which the slide demonstrates. This chart effectively shows you the economic growth history of the largest economy in the world, and that is the US. And here we can see that they've just experienced what under normal circumstances would be considered quite catastrophic. So this recession is very severe, as you can see, and it exceeds previous contractions by an order of magnitude. And this picture is not just limited to the US, it's actually occurred on a global scale across almost all countries. But why do we have this major disconnect between the economy and markets? Well, the next slide really speaks to that. So policymakers have stepped in a massive way, as Luigi mentioned, and provided stimulus to try and stabilize the global economy and to plug that hole that's been created by this enormous loss of productivity and incomes. Their response has been far bigger than in 2008, and they're throwing everything, including the kitchen sink, at the problem. And that includes lower interest rates, quantitative easing, buying government as well as corporate assets. They've committed to keeping rates ultra low until inflation actually materializes. And then on the fiscal side, we've got spending programs, tax relief, loan backstops, and even literally handing out cash in the form of stimulus checks in the US. The amount of money involved is almost 50 times that of Jeff Bezos' wealth, as we can see over there. So this has been a big driver, and it's almost put a floor underneath our market, because investors can see that governments and central banks are willing to do whatever it takes to keep the show on the road. And so markets, of course, are forward-looking. So while GDP growth data tells you what's already happened, equity markets tend to be more forward-looking and try to anticipate what's going to happen. And so right now, markets seem to expect that only good things will happen, but that's not necessarily the case. So this slide shows you the very steep drop-off in global equities that we've had, and a very sharp snapback. And to give you some context, we've just overlaid this onto the 2008 experience in gray. And this time around, of course, the drop was far steeper, but also the bounce was much quicker. It's also very interesting to note that it was around this time back in 2008 that markets started to have another wobble back then. So I'm not suggesting that, I'm not trying to make any predictions about this rather, but this is really a good reminder that things are not always straightforward. And I also wouldn't blindly hang my hat on the fact that markets will continue to go up in a straight line as they have, simply because we've got all the stimulus going around. There definitely will be setbacks that crop up, whether it be a second wave, geopolitical issues, US elections, who knows? But that's enough about global. What about South Africa? Unlike offshore, we were already in a recession prior to COVID hitting. And so our growth experience this year will be weak, like everybody else, but probably a bit weaker, in fact. Our economy will contract about 8% this year, as Luigi mentioned, but unlike many other countries, the rebound will be relatively weak. So our 500 billion stimulus package was surprisingly large, admittedly, and rates have also come down significantly. But the fact is that we are on a slippery slope at the moment, and we're balancing high indebtedness, unemployment, low growth. And so this chart really shows that growth will take a hit this year and will rebound quite slowly, depending on whether we take a single or double hit to growth. And so businesses that rely on the South African economy will experience a difficult time. Given that our economy faces challenges, where does this leave local equity, however? Well, the first point worth making is that South African equity is not a homogeneous group. Certain sectors are reliant on the local economy, be it banks or retailers, but others, and the majority of the large caps, in fact, earn most of their profits offshore, and Naspers is a prime example of it. It's not only a rand hedge, but it also participates in that tech theme which I spoke to earlier. While another bright spot at the moment is also resources, which have also done exceptionally well, given the success of platinum and gold and the run up in those prices. And so on the right, what you can see there is that the resource weighting is actually quite material in the caps wicks, and that PPS Equity is in fact overweight the sector. So this explains the strong performance that the fund has enjoyed over the past few months, and this trend we think is likely to continue as cyclicals continue to benefit from that rebound in global growth that we can look forward to. On the left, what we can see are the top 10 holdings in PPS Equity. There we can see that Naspers and Prosus are both top holdings in the fund, but a further 6 of those 10 top 10 stocks are actually resource names. And so the underlying managers in PPS Equity have been well positioned this year, and our overall performance has therefore been good. But I think I'll leave it there for now, and I'm going to hand back to Luigi. If there are any questions that do come up along the way, please feel free to pop those in the comment box, and we'll definitely try and pick those up at the end if we have enough time. Thank you.
Thanks, Reza. I think that explains the preference for global over local, as well as the rand hedge characteristics of our local exposure in our equity funds. But let's not forget about domestic bonds. And I'll turn to David now. David, the recent IMF relief package of $4.3 billion or 70 billion rand, as the cartoon shows, provides some much needed liquidity to our government, but the narrative has been more speculative. What are your thoughts on our fixed interest market, and how has this manifested in our funds and in the PPS bond fund in particular?
Thanks, Luigi, and good morning, everybody. So we took a high conviction position in South African bonds, as you alluded to, in late March, early April, when we felt we were receiving sufficient compensation for taking on the risks that are quite obvious in the South African economy. We still think we are being sufficiently compensated for that risk at the moment, although we'd arguably be more comfortable with the position if it was clearer that South Africa was more emphatically moving in the right direction to restore investor confidence. The IMF loan, which was announced recently, was one of the boxes we wanted South Africa to tick to show us that things were moving on the right track, and so that's quite a pleasing development. But clearly, the other big thing that we need to see are other measures to restore investor confidence, and here some more progress on corruption and combating corruption is clearly critical. The chart that I'm showing you below is from an OECD report that came out last week, and that just shows the South African debt to GDP trajectory under various scenarios, 2 of which you may have already seen in the supplementary budget that Tito Mboweni announced. And clearly, the rise in GDP to debt to GDP is concerning, particularly in the passive scenario. But in the other scenarios, it looks more contained. And one thing that really struck me when I looked at this chart was the relatively low growth assumptions that the chart was based on. So even in the progressive consolidation forecast and in the reform scenario, the OECD is only expecting the South African economy to grow at about 3.5% by 2025. So these growth expectations are not optimistic, and that gives us some comfort in that South Africa doesn't have to do an awful lot right in order to surprise on the upside. So, to Reza's comments earlier about how we are wanting to play the good news South African story, we see the bond market as providing us with a more realistic way to play this than the SA domestic equity market at the moment. And if we could just move to the next slide, I can talk more directly to our bond fund, which talks to how we're implementing this across many of our portfolios. You can see in terms of the top holdings, the chart on the left, that it's mainly a combination of inflation-linked and nominal South African government bonds, and this talks to how we try to build resilience in terms of how we construct portfolios. So we don't just buy nominal bonds or just buy inflation-linked bonds, but we do a combination of the two. And although the exposure to the inflation-linked bonds in particular has caused us some short-term pain as inflation has surprised very much on the downside, we're still very comfortable with this position in the medium term, given we see that inflation could well come back into the economy. And if you look at the chart on the right, that just shows you what the market's pricing in terms of its expectation of inflation, as well as the compensation it's requiring in terms of holding on to South African debt. In other words, the compensation that we need for this fiscal risk. And you can see the light grey bars are the market's expectation of inflation, and over the short term, it's very low, around 2% or under 3%. But as you see, as the market looks further out to 15 years, it's pricing in a lot more inflation, potential inflation, 6, 7, 8% potential inflation. And it's also demanding a lot higher compensation for holding South African bonds. So if we hold a 15-year nominal South African bond, you can see that we will get 5% return on top of compensation for 8% inflation. And we think that still looks very attractive. So when we established this position, we were getting an even greater compensation for South African bonds, but this compensation that we're currently getting, we still think is very attractive, and close to an equity risk premium still. So although this position, to Luigi's initial comments, has cost us a little bit in terms of short-term performance, we think it very much sets us up for a resilient portfolio going forward. And if we just now go to the next slide. Yeah, so, we're now in day 136 of lockdown, there's a sense of desperation from many businesses as consumers remain cautious with their spending. And we've previously commented that a U-shaped recovery or an L-shaped recovery is going to expose all but the most resilient of companies to significant fiscal distress. The time for talking is clearly over, and South Africa urgently needs to implement measures that are going to restore consumer and business confidence. And I think we're all waiting with anticipation for the government to announce some tangible measures that are going to give the investor community a lot more to be positive about. And certainly the IMF loan is the first step in the right direction, as is the talk around doing something about corruption. And hopefully we'll see both of these measures, more tangible efforts in both of these aspects going forward. Thanks.
Okay, thank you, David. I think now we'll turn our attention to one of the questions we faced with most often recently. When will the world return to normal, or whether the world will return to normal at all? It's quite a big question we faced, I think, in many different industries. So it seems highly likely that certain business models will have to change. Some may seem more obvious at the moment, like those relating to travel and tourism, but also possibly in the industry we all work in. We've seen over the past 5 months that virtual meetings have become an acceptable and sometimes even a preferred form of communication. What will this mean for the number of clients that can be served more regularly, as well as for closer joint communication between various stakeholders in the industry? The defining factor may be the length of time that the lockdown continues for, to determine how widely a new normal will be accepted. So David, I think I'll direct these questions at you. What's your view on the speed at which some semblance of normality will return? And do you see any unexpected positive consequences that has arisen thus far?
Thanks, Luigi. So clearly, COVID-19 has spread around the world. This chart just gives you an update of the number of cases and the fact that it's pretty much in every single country in the world. And it's not yet contained either. So there are a number of hotspots where there's more than 14 cases per 100,000 on a daily basis, and South Africa, unfortunately, is one of those cases. And even in economies where we felt it was under control, we've seen flare-ups again. So how do we think this is going to end, or what gives us cause for comfort or not? If we just move to the next slide, even though we've had 750,000 deaths, that's still about 1% of the number of deaths we had with the Black Death, when our global population was like less than 1/15 of the size of it is today. So clearly, the concern is that we've still got some way to go if we look at previous global pandemics and the impact they had on population growth. But on the positive side, we do have reason possibly to be more hopeful. And if we just turn to this slide, the gentleman on the right, I assume it is a gentleman, is a medieval doctor who believed the plague would have been caused by evil spirits. So he's trying to ward off evil spirits to protect the plague, to protect us from the plague. Obviously today we have medical science and a number of global companies all working on a vaccine. So this is just a snapshot of a number of companies at the moment all desperately trying to bring a vaccine to market. And clearly if a vaccine were to come to market, that's potentially a massive game changer. Just a word of caution, if a vaccine comes out in the next 18 months, it's going to come out twice as fast as any vaccines ever come out before. So the fastest vaccines come to market was with mumps, which was in the 1960s, and that took 5 years. So if we are able to bring a vaccine out from within 2.5 years of this coronavirus, it's going to be, the quickest we've ever done. So, don't necessarily read too much into that. And when we think about resilience, we certainly are trying to think that maybe it's going to take some time for this to normalize. The other challenge with the vaccine, apart from producing 8 billion samples, which is what you need to give to everyone on the planet, is whether people are going to take it. And that might sound surprising, but a number of studies have suggested the population might be quite nervous about taking vaccines. So the latest I read in the US was 3 out of 4 Americans said they would not take a vaccine, even if it was produced. And clearly, we need that to happen. We need a widespread take-up of the vaccine in order for it to be able to return to normal. So, this is a scenario that could happen, and we should be prepared for the fact that we may get a vaccine. But it's certainly something that we're not banking on in terms of a likely outcome. If we just move to the next slide. The other positive is it's fairly obvious what South Africa has to do in order to fix certain things. I mean, there's been a number of discussion documents that have been released in the past 1 to 2 months from a number of players saying what needs to happen. And I think there's general agreement about many of the things that we need to change. And really, it's just the political will or the political ability to focus on 1 or 2 things and to land it, which is the problem. But we all know really what the challenges are. And outside of Eskom, which is clearly something which is potentially very destabilizing to our economy, the public sector wage bill is probably the second biggest challenge. It's not practical for almost 60% of our tax revenue to be paying the salaries of 2.5% of our population, which is how I heard an economist put the public sector wage bill in perspective the other day. The OECD report that came out last week, which is freely available on their website, that I talked about a bit earlier, also just compares South Africa amongst the other OECD countries and other developing countries. And it's clear that our public sector wage bill is high relative to both the OECD average and other economies. And if we can get some traction on fixing these obvious issues with Eskom, with the public sector wage bill, with corruption, there's a lot of upside for South Africa there. And maybe just talking to the next slide. Yeah, this slide is, I suppose, an open invitation to all of us to take advantage of this crisis to try to change our behavior. And whether it's the Me Too movement or the Black Lives Matter movement or the climate change emergency, we do feel that we're probably at an inflection point at the moment in the globe. And the asset management industry ourselves are grappling with ESG issues. And although it's probably fair to say South Africa's maybe a bit behind the global trends with regards to ESG, it's something that our managers and ourselves and our clients are increasingly taking quite seriously. And I suppose COVID has been accelerating all these changes, and let's all try to make a concerted effort to emerge from this crisis and by making some fundamental changes that can leave the world a better place afterwards. Thanks.
Thanks, David. It's good to hear a bit of a silver lining, at least in these uncertain times. So in line with our theme of building investor resilience and keeping in mind that for every investor, the best approach is to be invested according to their needs and their risk profile, I'll turn to Reza and ask how the PPS funds asset allocation has evolved through the lockdown and what manager changes have been implemented across the portfolios.
Sure, thank you. In short, we haven't made any major changes to our overall house view since we last presented here. So our key overweights remain South African bonds, as you mentioned earlier, which are offering good compensation, we think, despite the risks that have been highlighted here today. And these are also supported by the fact that interest rates will stay low for the foreseeable future. We're also constructive on offshore growth assets, as I've mentioned, and that includes both global equity as well as global listed property. property are obviously offering quite a nice compelling yield with some upside growth potential as well. Global equity valuations are reasonable, but there are pockets of value to be found around the world as well. And we tend to rely on our managers to be able to seek out those opportunities, which they have done quite well. So global bonds, on the other hand, remain unattractive. The yields on offer are very low, and we think these are expensive. So when it comes to South Africa, we're more cautious on growth assets, however, and we are underweight local equity and local listed property. But just to put that in context, perhaps, our approach is not to make large tactical asset allocation shifts and tilts to the portfolio. So you'll find that these tend to be quite measured within the context of our framework. And so in addition to that, our multi-asset managers in the portfolio tend to either accentuate or counter that. And so through applying their own asset allocation frameworks, they also add an element of diversity and resilience to the portfolios. And then on the last slide, we can see some of the manager changes that have taken place over the past year and a half or so in the context of local and foreign equity. Capital on the top left, you'll be quite familiar with by now, but they're essentially our global equity manager of choice, and we're quite proud of that relationship. This really is an exceptional business with a phenomenal track record over a very long period of time. And the way that portfolio is managed means that it can easily exist as either a standalone solution or as part of a portfolio as we have it in our funds. And they now manage a meaningful pool of assets for the multi-manager portfolios. Below that, Lansdowne, we've recently exited to make way for capital. And this is part of our overall drive to hold a higher conviction spread of fewer managers in the portfolios. But also the liquidity constraint that comes along with investing in Lansdowne is also something that we have sought to eliminate. And then in the local context on the right, you can see that Fairtree has come into the portfolios as at the end of last year, which thus far is working quite well. But in addition to that, we've also brought in Truffle about a week or so ago. And like Fairtree, Truffle is also a boutique manager. They're slightly smaller, managing around 20 billion in assets under management. But they've got a very strong track record in managing both South African equity as well as balanced mandates. And their approach lends it well to the complexities of navigating the South African market. So they're a valuation-based manager, aware of the benchmark, and they also overweight stocks that they like and underweight those that they don't like. They've got a bottom-up and top-down element to their process, and we think that tends to work quite well in the local market, which is often quite macro-driven. And then in terms of managers that we've exited, these tend to be predominantly quite style-biased managers, and our current thinking in the equity fund is really to favor those managers with fewer constraints that are better placed to take advantage of the often narrow set of opportunities that tends to arise in the local market. And that's really where we stand, Luigi. I'll hand back to you.
Perfect. Thanks, Reza. As a team and as a business, we've certainly embraced technology, and these changes, one can see that it's been business as usual, even though we've been working from home since a few days before the official lockdown actually started. I think I'll end with my questions, but summarize the discussion with these 3 points. We remain sensibly diversified. Number 2, we believe our partnership managers are sensibly positioned. And number 3, although the path ahead is unclear, opportunities arise if you are open to them. So thank you for your time this morning. We've deliberately left a few minutes for questions, and we welcome any questions. In fact, I've just heard from Razik now that there is already a few questions that have been asked. So I'll turn to Razik, who will moderate these. Thanks, Razik.
Thank you so much, Luigi. Yes, I see we've definitely got quite a couple of questions. A lot of them focus on property, so I'll get back to you, Luigi, with regard to the property. The first one that came through is actually for Reza. Reza, with gold prices having reached new heights, how high can it be expected to go?
So thanks, Razik. Razik, that's a very topical question at the moment, with gold having certainly breached that $2,000 level. It certainly is a record high. And so what's driven that really is that gold is an interesting one. I mean, it's got some investment properties to it, but also there's a speculative element to it. There's very little industrial use for the actual commodity itself, and so it tends to be driven by sentiment in markets. And so what has driven that really is partly the fact that real interest rates are very low. And so the opportunity cost to hold in gold, gold obviously it doesn't pay a dividend of any sorts. And so with real interest rates low as they are, and companies really paying bonds, offering very low dividend yields, the opportunity cost to hold in gold is quite low. And so that obviously has contributed to the strong price performance. And then secondly, we've got a tremendous amount of stimulus happening in the world, a tremendous amount of currency debasement happening, money printing happening. And so that actual security of holding on to a real asset, I think appeals to many, and that's also driven the gold price. But it's very difficult to say how much longer this will go on for. We certainly don't think that it is about to end. But I mean, I would certainly say that there is definitely still some upside to holding gold. It's very difficult to know what the fundamental value of gold should be, because you've got no cash flows to sort of base that on. And also the supply of gold over time, it really it just keeps growing over time, because of that fact that it's got it doesn't have an industrial use, so we don't really use it up. And so sure, I mean, there are some tailwinds. Certainly what's nice though is that managers in our funds have been able to participate in that. Some of those hold the actual commodity, but many of them hold the gold companies, and those gold companies are also benefiting from the fact that the prices has risen, and also the locally listed ones also benefit from the fact that the rand has been weakening, and so that's generated very strong cash flows for them. So yeah, no, absolutely. I mean, the gold price certainly is going higher, and certainly there appear to be some tailwinds behind that.
Thanks so much for that, Luigi, Reza. The next question we have here is definitely one for David. David, not sure if you've seen the clip Dr. Roelof's Botha that circulated a day or two ago. Are you guys just as optimistic about seeing a V-shaped recovery?
Thanks, Razik. I haven't seen the clip, but I mean, we don't see a V-shaped recovery. It hasn't been our base case scenario since March. We basically felt that it's much more likely to have a U-shaped recovery, and that talks to the positioning that we've done in the portfolios where we've underweighted SA equities that we felt would be more vulnerable to a more protracted U-shaped recovery, and that we favoured globally managers like Capital, who we think can find companies that are going to be able to benefit in a kind of U-shaped recovery. So yeah, so we don't think the V-shaped recovery is the most likely scenario, and that yeah, and that view hasn't changed. We do think though that South Africa is being given no benefit of the doubt in terms of being able to exceed expectations, and possibly we are increasingly thinking possibly maybe South African growth could surprise on the upside given how poor the expectations are, and that obviously will be positive for our bond position, and it will be positive for SA domestics. So it's possibly our expectations are very modest now after being disappointed for 10 years in South Africa, that we might see a growth surprising on the upside relative to very pessimistic forecasts. But no, we don't see a V-shaped recovery as the most likely scenario.
Yeah.
Thanks so much, David.
Maybe Razik, if I can for 1 second before we ask the next question, just add something there if that's possible. So I mean, there is a difference also in terms of V-shaped recovery, in terms of what the market has done and what GDP growth in an economy does. And I think sometimes the two gets blurred to some extent. And when people speak to the V-shaped recovery, I think a lot of the time they're actually referring to GDP growth, and can we see that growth coming through strongly in an economy, and that's where we see the difficulty. Sometimes there's a lot of short-term volatility in equity returns, and we can take advantage of that. But that's not to say that we think that growth is going to return very strongly to our markets.
Thanks so much, Luigi. While I have you there, the next question is we have about 2 or 3 questions all revolving around property. So I'm gonna pitch the one in the middle here where it says here from Nick. I think we're all worried about the commercial property industry. With more people working from home, companies don't require huge office parks, buildings. So in your opinion, how will this affect commercial property portfolios? There's also plenty of other people wanting to understand what will happen in the property market and your view on property as well. So if you don't mind giving us a little summary on Nick's question as well as property in general?
Sure. I'm not surprised there's properties questions on property. And it's interesting, Nick's perspective. I mean, normally we get the question from the other side actually, and saying like the property prices have actually run down so low. Is it not a perfect opportunity now to buy some property, especially that because the yields also high? And there's lots of question marks. And I suppose we also come from a mindset where domestic property was a well-loved asset class and gave quite strong returns for a number of years in our market. So I'll start by saying that in our portfolios, our domestic property exposure is at a maximum underweight at the moment. So that's kind of the first clue that we are still uncertain about the prospects in property. And I think the reason is because of the question of how things will change once the lockdown has concluded. If we take ourselves, for example, we have a company of about 140 staff, about 110 are based in our Cape Town office. And would we, going forward, continue to have 110 desks for the 110 staff? I'm not so sure that will be the case. I mean, nothing's decided yet, but I mean, a lot of companies are thinking along those lines. Maybe there's a room for flexibility. It's kind of been proven that virtual type of meetings and virtual settings are the way of the future to some extent, and that can work. I'm not to say that this face-to-face interaction won't happen anymore, but the opportunity, I think, is more acceptable now for lots of people. And so we've been cautious around taking larger stance in the domestic property space, because we can definitely see there are some headwinds. From a yield perspective, and a lot of the time South Africans think about property and what you can earn from the yield on property. If you look at the last dividend paid from property, that would seem like it has been high because the prices come down to a large extent. But the ability for that yield to continue to be paid has to be questioned as well. That also begs the question if property or renters are able to continue with the increases that they've seen in the annual rentals going forward. So for us, there's too many question marks at the moment to be very positive about it. Yes, we can see from a valuation perspective there is an opportunity in that regard, rather than being too aggressive. From a relative perspective, as well, we can invest in bonds, and as David showed not too long ago, in a few slides ago, the yield that we can earn in the bond market is quite attractive as well. So from a substitution perspective, we can rather invest in bonds where we know there's a lot more certainty in the outcome compared to property. There's hopefully answered the property question, Razik.
Thanks so much, Luigi. Yes, no, you definitely did. We have another one. This one, David, you can handle this one first, please. It's not obvious that COVID-19 has caused companies to be between 30 to 40% below budget. Therefore, it's about survival for them, and no dividends can be expected for at least the next 2 years. Share should be about 30% lower, and therefore, who and what is keeping it artificially higher than what it should really be? Real PE ratios are ridiculous. Any comments on that question?
Well, yeah. Well, I mean, the share price obviously discounts all future earnings up to, an infinite number of years going forward. So, because there's pressure on the next 1 to 2 years, that doesn't necessarily mean that the share price should be down an equivalent amount. So, even if companies aren't able to pay dividends in year 1 and year 2, that doesn't necessarily mean that their share price should be down 30%. And to Reza's point, because global interest rates are so low, the future cash flows that they're paying in years 3, 4, 5 up to 50 are discounted at a low interest rate, so have a lot more value than they normally would have. So the market's able to look through the short-term 1 to 2 years, and therefore it's not necessarily outrageous, the valuations at the moment. I mean, the big debate that the asset managers are having, or that we were having in late March, was the valuations look very enticing, but which companies will survive and which companies won't survive. If a company is going to survive, the valuation looked attractive, but you weren't sure whether it was going to survive or not. So we would argue when we look at equities, the big issue is try not to invest in the companies that aren't going to make it. The fact that they may or may not pay dividends for the next 2 years isn't that material given our long-term investment outlook when we look at equities. It's more whether or not they will be around in years 3 than whether they will pay dividends in years 1 or 2. And I think that's how the market's also looking at it. It's more to focus on whether the company will survive than whether it won't pay dividends for the next 2 years, which in the greater schemes of things in an equity investment isn't actually that relevant to the valuation.
Thanks so much, David. I see we have another question here. This one is for Reza. Reza, what's your view on the rand for the next year? I know you love this question.
It's always difficult talking to the rand because I mean it is one of the more volatile currencies around the world. It's I think one of the most traded emerging market currency, and so whenever something happens in the world that's sort of relates to emerging markets, you tend to find that the rand is also affected by that, and so it's very difficult. I will maybe start off by saying to forecast what the rand is going to do over the next 12 months. But maybe just to give you a sense for valuation, and so there are various ways one can look at it. You can look at purchasing power parity, which is one model that's often used, and it's obviously quite sensitive to the starting point of that analysis. But I mean, that seems to suggest at the moment that the rand is undervalued or cheap. And if you look at the real effective exchange rate as well, which is another way of looking at the valuation of the rand, that also seems to suggest that the rand is slightly cheap at the moment. And then on the other side of that equation, you've got the fact that what also affects the currency is portfolio flows. And locally, we have seen a tremendous amount of outflows from our bond market as well as our equity market. But that also tends to have a short-term effect on the rand's move. And so generally our long-term view on the rand, maybe I'll start with that and then I'll come back to the short-term. Our long-term view on the rand is that over time it will continue to weaken as it has over the past few years. And that's largely driven by the fact that the inflation differential between us and the rest of the world, as well as the interest rate differential, actually mostly the inflation differential rather, that tends to mean the fact that we've got high inflation locally compared to offshore. It really just is a force that tends to mean that over time there will be this continual weakening of the rand. And so long term we're quite negative on the rand. Short term, however, an interesting thing has happened, given obviously COVID has come about, and our exports have been actually quite significantly affected, and so we export predominantly resources, and the price of those have gone up. At the same time, the extent of our imports have also gone down, and so our terms of trade have improved quite dramatically. And so what that has meant is that the rand has strengthened surprisingly over the past few weeks and months. It's come all the way back from 19 down to 16, and it's back at 17 odd at the moment. We think that that period of strength is now over, and that we will now resume that sort of weakening bias. And so if I were to have a guess, I would say that the rand continues to weaken over the next 12 months.
Thanks so much, Reza. The next one is for Luigi. So Luigi, what is the link between SA bonds and the huge public sector bill? Isn't this bill eating into SA bonds? Please help us understand.
I mean, that's a very good question, a very topical question as well. And it talks to the issuance in the bond market. So what the government does, that every week they issue some bonds because they want to borrow money into the economy, and it also in the hope that both local investors and global investors are buying South African bonds. So the yield that we're getting in South Africa, those, I mean, it's a very good yield that we are earning if you consider that globally a large part of global bond market is actually in negative yields. So that is quite a positive from a South African perspective, and we're still seeing that those issuances have been oversubscribed. The volatility, though, in terms of the yield that we've been getting on our market has not really been as a function of the requirements from or it has been, let me say it like this, Ron, it's been a function of the concerns about emerging markets in general. And so when we saw that COVID happened and the lockdown occurred, kind of a risk-off trade occurred in the world. And we saw that global, also South African bond yield spiked significantly at that time. And we actually thought that that's an opportunity to buy more bonds because we could lock in those significant yields that were well above inflation. We are though in a situation where our debt levels have been increasing, and David showed that the chart of what it looks like in terms of how debt to GDP ratio is likely to increase. But we definitely not want to get into that scenario where those levels increase too much, because then it becomes too difficult for our government to pay off their debts, and that could mean that those bond yields can start to increase again. And so this is definitely a delicate balance between what's an appropriate yield that the government can pay and what's a too expensive yield that they need to pay because they need to get more debt into the economy, or in order to pay bills. And as David showed in a few slides ago as well, it's currently about 60% of all government income is used to pay that public servants, and so it's quite a big bill. And part of that, in addition to that 60%, about 19% is just to service the interest on that debt. So there is a correlation between the two, but at the moment I think it's not that it's over that tipping point yet. We still see that as an opportunity to take advantage of. If we think that currently the last inflation print was at 2.2%, and we can get bond yields from the government at north of 8, 9, 10%, depending on the maturity, we still think that real return that we can get is actually very positive for our portfolios.
Thanks so much, Luigi. Just continuing with you there. I'm talking for very conservative clients as well. Is cash still worth investing given the drop in interest rates?
Yeah, so that's a topical question as well. We've been seeing many questions around this point. As we know, not too long ago, the end of last year, cash was still yielding a significant return above inflation. Of course, throughout this year, we've seen that the Reserve Bank has reduced interest rates, short-term interest rates, a number of times, so that the repo rate's now at 3.5%, which is the lowest level we've seen in as long as I can recall. And so it's not that compelling to be a cash investor any longer. I would say there's a portion of a portfolio, maybe from a very low risk perspective, that could be held in cash. But if you compare the return you can get on cash, 3, 4, maybe 4%, 4.5% possibly, compared to investing in bonds where you can get 8, 9 to 10%. Yes, there's definitely more short-term volatility from investing in bonds. That you can be fairly secure that the government will pay back the loans because effectively, I mean, they can print money. And you do not want to get into a situation from a cash perspective. If there's a surprise in inflation and you are now getting a less than inflation return for an extended period of time. It's kind of you are invested, but you're still going backwards in terms of your purchasing power. There's a lot more opportunity, I think, in the rest of the market to not have a substantial part of your investment in cash. And we definitely, as you can see from our house view, we've rather taken the view that we've started to reduce the cash holdings across our portfolios.
Thanks so much, Luigi. The next question that we have listed here is actually for David. David, I know this one is near and dear to your heart. So with regards to ESG, do you incorporate it into your investment process, and how do the managers in the funds that you look at ESG both locally and abroad?
Thanks, Reza. So, I mean, ESG has become very topical, both in South Africa and globally, and South Africa managers have definitely moved forward in terms of how they're thinking about ESG. It's still a component that's evolving, so we don't yet have clear guidelines as to how should we apply ESG, and a lot of the methodologies that are available not necessarily all consistent. So at the moment, ACESA and various bodies are working on coming up with common standards, which I think will make it a lot easier for us to apply it more meaningfully in the portfolios or more consistently. But at the moment, as a multi-manager, we are allowing each of our managers to interpret ESG in the ways that they think is most relevant, and then we will assess each manager in terms of how they've assessed that particular ESG risk. So that might sound a little bit of a convoluted answer, but it's trying to indicate there's no necessarily one way to do ESG. There's a number of different ways that one can apply it, and we think the multi-manager process, where we can have different managers thinking differently about it, is probably the most robust way to think about it, because who knows which manager's approach to ESG in the long run is going to be the right way. But all managers that we deal with are thinking about it in terms of the implications for the business's ability to earn sustainable revenue going forward. So it's definitely something that has evolved significantly in the last 12 to 24 months. Our regulator is also looking at it from a retirement fund perspective, how to make it more operational, and it's definitely a core component of our due diligence process. So when we engage with managers, we spend a lot of time trying to understand how they think about it, how do they analyze it, when the analysts look at companies, how do they think about it. We do quite a detailed annual questionnaire to managers as well around this particular issue. But at the same time, I wouldn't necessarily want to say that that there's a very clear outcome in the world as to how we should apply it. I mean, different managers are thinking about it differently, and this sector is evolving. So I mean, we're keeping abreast of it, but it's by no means there's no means one clear answer as to how one should apply it. Even within our membership base, let alone amongst the team, people will have different views about how you should rate various components of ESG or which one's important. So it lends a lot of debate into the team. It lends a lot of discussions with the managers, but as of yet, there's no one clear way of applying it consistently across the portfolios. I think when we're able to report on companies in a kind of industry agreed manner, it's going to make a lot of difference. So we are tracking various ESG metrics in terms of our portfolios. But again, that methodology is not without its challenges. So the sector's evolving. There's a clear need to make progress on this, but as of yet, it's not kind of completely standardized, I suppose, and completely clear. So it can be quite misleading, some of the ESG metrics, as well as quite insightful. But it's something that we're working very closely with our managers on, and the industry is working on in order to make it more operational. And I've got no doubt going forward, it's increasingly going to be a core component of what we do.
Thanks so much, David. I see we have one more question here, also directed for you. Given the ongoing US-China trade wars, what are PPSI and Capital's view on Asian stocks? Any view on Alibaba?
I mean, Reza might be better placed to answer that specific global equity question than me. We would, yeah, I mean, the trade wars is obviously quite complex, and there's a November US election, which is also indeterminate at this stage, but looks less likely that the incumbent will be re-elected. Yeah, I would think the trade wars are hopefully going to be resolved in the next 6 months. In terms of Capital's particular view, to Reza's point, Capital's got 7 portfolio managers that independently construct portfolios, so they don't have one particular view. They've carefully combined managers in their business to run portfolios, and that results in a more diversified overall outcome. So they won't have one single view on China trade war. And as a multi-manager, we'd also try to be a little bit more diversified in terms of than taking one particular view in terms of a trade war. Clearly, at the moment, the bigger issue is arguably how does the world re-emerge from lockdown successfully without the coronavirus flaring up. I suspect then the extent of the US trade war causes more instability. So, I mean, our more immediate concern is, are we able to open up economies successfully? And that seems to be taking more attention at the moment than a US-China trade war. but both these aspects are evolving, and we would hope in our managers, how they find companies, they will be finding companies that can benefit despite a US-China trade war. Our manager like Capital has a massive opportunity set of companies to select, and even if there is a trade war, certain companies will do better than others, and we would hope Capital would have a better than 50-50 chance of finding those particular companies. So that's a bit of a general comment rather than a more specific, but yeah, I think we're not particularly focused on the US-China trade war in terms of how we're thinking about how we need to be positioned.
Thanks so much, David. Reza, our last question, I think we've actually just run out of time. Last question I'll be posing to you, Reza. Tell me, do you think global might be experiencing a bit of a bubble, especially tech stocks?
Thanks, Razik. That's quite another very topical issue at the moment. And I've tried to kind of hint at that slightly, maybe in the commentary from earlier, but I haven't explicitly called it a bubble. The thing about bubbles is that you only really become aware of it after the fact. And so after you've had that exuberance and then you've had a sharp drop off, that's really only when you become aware of the fact that perhaps we have been in a bubble. So there are certainly signs at the moment that maybe the market might be getting a little excited, but that's not the entire tech sector. It's really, if you look at a few select companies like the Tesla, for example, the stock price has run up very sharply to a point where some managers are finding it hard to justify those valuations. Other managers, however, continue to see blue sky for that particular company, because it's far more than just about creating electric vehicles. And so Bailey Gifford, which is one of the managers that we hold, as well as Capital, in fact, are some of the larger shareholders in that particular company, and they're still quite constructive in that company. And so are we in a bubble? I mean, certainly some of the valuations are becoming a little bit stretched, but I mean, unlike back in the tech mania of the 2000s, valuations back then really were sort of eye-wateringly high. It was very difficult to justify those valuations. The companies weren't backed by actual cash flows, whereas now things are quite different. But I mean, I would say that we aren't necessarily in a bubble yet. It's hard to say for sure, but it does seem that there is quite a lot of excitement in that area, and that does seem to suggest that maybe we are heading in that route. That certainly is not meaning to say that we are absolutely in a bubble and that's going to come crashing down. I mean, often these things tend to run for a lot longer than what you might think. But if you look at, for example, one of the largest companies in the S&P, which is Apple, the largest company actually, it's 6.6% of the S&P index. And at the peak, IBM back in 2000 was 6.5% of the S&P. And so that concentration that you're seeing in tech, in the largest index in the world, as well as the global equity index, and you are certainly seeing a concentration of these tech names in the global equity indices. And so once again, yes, we are seeing signs that there is excitement in the sector and enthusiasm, but I don't think we're at a point where we can really call it a bubble yet.
And just in wrapping up, I'd like to say thanks to David, Reza, and Luigi for another brilliant session. And with so much uncertainty, the information you share with us today will definitely help advisors navigate this ever-changing environment and to keep clients on track with their actual investment goals. To all of our attendees today, I'd just like to thank you once again for taking the time to join us. We will definitely be sharing a recording and a summary of this session with you. And lastly, I'd just like to say good luck out there, guys, and please stay safe. Thanks so much for joining us. Well, goodbye.